Most people think they underperform the market because they picked the wrong stock. But the truth is quieter and harder to admit. Even the S&P 500 isn't what beats most investors. They beat themselves. Morningstar found that over the last decade, investors earned about 1.1 percentage points less per year than the funds they already owned, just from bad timing. Fear makes you sell. Ego makes you trade. The perfect entry makes you wait. And the news makes you react. In the next 10 minutes, we'll expose these 4 mental traps and the simple rules that disarm them. This isn't opinion, it's data. Dalbar has tracked investor behavior for over 30 years, and year after year, the average equity investor underperforms the market. In 2024, the S&P 500 returned over 25%. The average investor, around 16%. An 8-point gap in a single year. And it doesn't stop there. Morningstar's Mind the Gap study looked deeper, not at the market, but at investor timing. Over the past decade, the average investor earned about 1.1% less per year than the very funds they were invested in. Not because the funds failed, because investors moved in and out at the wrong time. 1% per year may sound small, but compounded over 20 years, it's the difference between wealth and mediocrity. The market didn't take that money, behavior did. The first trap is the most human one: emotion. When the market falls, it doesn't just hit your portfolio, it hits your nervous system. Your heart rate rises, your thoughts accelerate. Every red number feels like a threat. Psychologists call it loss aversion. Losses hurt about twice as much as gains feel good. So when your portfolio drops 10%, you don't see long-term opportunity, you see pain. And the brain is wired to stop pain immediately. So you sell. Not because the strategy changed, not because the fundamentals collapsed, but because you want relief. And the market often rebounds without you. But fear isn't the only emotion. Greed is quieter, more seductive. When markets surge, when everyone is making money, when headlines scream new highs, you feel behind, you feel late, you feel the pressure to act. So you buy more, you increase risk, you chase what's already running, not from logic, from excitement. Fear makes you sell low, greed makes you buy high, and over time, that cycle becomes the gap. The market doesn't need to beat you, it just needs you to react. The second trap is more dangerous than fear, because it feels like strength. Overconfidence. Most investors believe they are above average, smarter, more disciplined, more informed. But statistically, that's impossible. The market is a battlefield of professionals, institutions, algorithms, people with more data, more speed, and more experience. And yet, we believe we can outsmart it. Psychologists call this the illusion of control, the belief that because we act, we influence the outcome. But in markets, activity does not equal control. Research by Barber and Odin studied tens of thousands of individual investors, and they found something brutal. The more people traded, the worse they performed. The most active traders earned dramatically less than the market itself, not because they lacked information, because they believed they had an edge. Every trade feels intelligent. It feels proactive. It feels like progress. But often, it is just ego in motion. Stock picking becomes identity. Predictions become pride. Admitting you can't beat the market feels like admitting weakness. So instead of building wealth, you defend your intelligence, and the market quietly collects the difference. Feels intelligent. It feels patient. It feels strategic. I'm just waiting for the right entry, the perfect dip, the confirmation, the signal. But the market does not reward perfection. It rewards participation. Study after study shows the same pattern. Miss just a handful of the market's best days, and your long-term returns collapse. And here's the part most people ignore. The best days often happen right after the worst ones. So when fear pushes you out, you are not just avoiding pain, you are positioning yourself to miss the recovery. Timing feels powerful. You feel in control. You feel selective. But in reality, you are reacting to randomness. Markets move on information you cannot see, on decisions made in rooms you will never enter, on algorithms that execute in milliseconds. And yet, you believe you will step in at the exact right moment. While you wait for certainty, compounding waits for no one. The cost of bad timing isn't just one mistake. It's the accumulation of missed days, missed rebounds, missed years. Perfection is expensive. Participation is not. Step back, because this isn't just about you, it's about the environment around you. Turn on financial news. Every headline is urgent. Market crash incoming. Stocks soar to record highs. Is this the next bubble? Fear keeps you watching. Excitement keeps you clicking. Calm doesn't sell. Media profits from volatility, not from discipline. Then there are brokers, zero commission trading, instant notifications, confetti animations when you place a trade. It feels like a game, but the more you trade, the more profitable you become. Not for you, for the system. And now, social media, endless opinions, hot takes, predictions. Someone is always making money. Someone always knew it would happen. You don't see their losses. You see their highlights. And comparison creates pressure. The system rewards activity. It rewards confidence. It rewards bold predictions. But long-term wealth, it rewards patience. So you are surrounded by noise that amplifies fear, inflates ego, and pressures timing. The market does not need to trick you. The environment does it for free. So what actually works? Not predictions, not hot stocks, not perfect timing. The answer is almost disappointing. It's boring. Broad index funds, consistent contributions, long time horizons. Owning the market instead of trying to outsmart it. Dollar cost averaging. Investing whether the market is up or down. Not because you know what will happen next, but because you don't. This strategy doesn't make headlines. It doesn't impress friends. It doesn't create adrenaline. But it quietly removes the traps. No stock picking ego, no timing paralysis, no emotional exits. It replaces decision-making with discipline, and discipline compounds. Over 10, 20, 30 years, the boring investor often outperforms the brilliant one, because simplicity is harder to sabotage. The market rewards consistency, not intensity. So, after all the data, after the studies, after the strategies, what's the real enemy? It isn't Wall Street, it isn't hedge funds, it isn't algorithms. It's the moment you abandon your plan. The moment fear convinces you this time is different. The moment ego whispers you can outsmart the system. The moment impatience tells you waiting is weakness. We like to believe investing is an intelligence game, but it's not. It's a behavior game. And behavior is hardest to control when money is involved. The market will crash again. It will rally again. It will scare you. It will tempt you. And every cycle will ask the same question: will you react or will you remain? Because the gap between the market and the average investor is not skill, it's discipline. Most investors don't lose because the market is unfair, they lose because they fight it. And the market always wins.